I'm making this is like an educational video talking about what is a short, how do you short, what can you short, and it's going to be a long video, and I'm really excited about going over this because it is a very complicated video because a lot of people don't understand what is a short. They just know a short is basically going the negative way. A short is when the stock is going up, a short is not making money. Well, they don't understand why, how. How is a short losing money when the stock is going up? How is it they're making money when the stock is going down? This is a very much I'm gonna try to teach this in a very basic way because a lot of people don't get it, and still today people don't understand how can you make money off when the stocks are going down. It is quite complicated, but the short concept came out into around when pretty much when a public company came around, and that I believe that was the Indian Corporation around the 1500s. There was the flour industry was very rapidly growing, and a guy came out and he created a short. He created the marketing on a short and how a short has started. The history of a short basically still goes today. We still have shorting, we still have longs, and we still invest into companies. So if you understand, a short is basically opposite of a long. When you go long onto the company, you are buying into the company. You are buying into, you are going long. You want the company to go up. So that is a long. And when you are shorting it, you want the company to go down. You're shorting it, meaning it's a short-term investment. You want it to go down for short term. So that's where the term long and short, because you're holding on to it for a long term. You want to expect to be there for years. The company to be there for years. When you short it, you want it to be there for a couple months, and then you're out of it. So how does a short work? This is the complicated system. So I have Ford. Ford is the company. Now Ford, I'm not long, I'm not short, I'm basically neutral on Ford. I had stocks in the past for Ford. I made money, I sold out. I think it's a good company still, but I'm using it for example. So let's say, for example, here you go, Ford. We were gonna buy 100 shares, and we got 100 shares right here, and we're gonna buy it for a 100. Let's do for the price right now. For let's do 100 100 shares for $11.50. The short, sorry, I'm getting into the short already. So you would have to buy and dish your money for 11. You'd have to have this much money to buy the stock. I'm gonna double check because you know what, I probably calculated that wrong. Knowing me, even though it's simple math. And yes, I'm correct. So you would have to take that money and give it to Ford. You're basically buying into the stock. You're buying, and so you're going to, that money is going to go. It's going away. You're no longer going to see that money. You don't have the money anymore. It's going to Ford because they're going to be using that money for building cars, building whatever, building transmissions, building a whole bunch of other stuff. So now, say for instance, that is going long onto the company. Now we want to short it because I think that Ford is going to be doing not so good because of a recession. And go figure, I think we are in a recession right now. So it is a really ideally of a company when recessions hit, car industries hit very fast, and they usually do not so good. So you want to short it. We want to short it, and we want to take again, we'll make it simple, 100 shares of shorting. So sides of us paying that money, we are going to receive the money. We're going to receive this money in our bank account. That's going to be ours. We're going to receive that. So this money is going to come into our bank account, into depositing, and we would have borrowing now because we're borrowing those shares. So we're going to be borrowing these shares because we don't own the shares. We're borrowing them for $11.50. And the banker, because it's a loan now, basically picture it as a loan. We are going to be getting a loan, and the loan will be the same amount of money. We're getting a loan. We are getting a loan from the bank, and what we're doing is we're getting a loan from the bank, and what we're doing is we're borrowing 100 shares that we don't own. We don't own them. We're just borrowing these shares. These are just from Wall Street. We're borrowing them, and because we're borrowing them, we are borrowing at $11.50, and then we have this. We will get this money. We have to pay interest on it, just like a loan. We have to pay interest. We'll have to pay because we still have to keep these 100 shares. So, say for instance, now we still have this money in the bank account. The money does not go away. Say for instance, it goes to $10 per share. So when it goes to $10 per share, well, we would make $150 because you take that $10 and we're going to buy our shares back because we want to buy them back, right? We have to, because we are borrowing these shares, we're borrowing them, we have to buy them back. That's shorting. We have to buy them back. It's just an obligation onto it. So we have to buy them back in the market, and we'll have to buy, for us paying them back. Well, guess what? Oh, oops, wrong one button. We have to pay $10 equals that. We will be paying out of our pocket $1,000. So we got this money, that was from a loan, and we paid the loan off with $1,000. That's pretty much it. We took a loan out, we had that, and we said, hey, we can pay it off, the loan, for $1,000. Well, that loan gave us a profit of $150 because the market went down. We borrowed it at $11.50, and then it went down $10. Well, we made $150. We made $150. Now, say for instance, the market's just going nuts. It's going down, and the stock's worth $1 per share. Well, we buy it back $1 per share. Well, we have to buy it back. We bought back the shares for Well, that would be $100. Well, let's take that, and you basically your profit off of this. And I should probably just do this in my head. I'm almost there. And we would be making a profit of $1,050 on a profit. Woohoo! We are making money. And this is how a shorting works. So you can short, and once you figure this out, you figured out how shorting works, it's unbelievable. You can short anything. So I have Ford right here in the background. You can see the pricing. And the reason why I'm saying that is because you can basically figure out how to short anything. It's because once you figured out how to short it, it is a very, very interesting game. Because where you can get yourself into trouble. We've seen the market going down. Well, let's see. You see the market going up here. Look at that. Look at that. Woo. Ah, shorts don't like that. You don't want to see that. That's not a short dream. That is a long dream. Let's put it that way. Well, so that would make your longs, if it goes up to $11, boom, $11. We're at $12. It's almost $12 per share. Well, $12 per share. Now, to buy these back, to buy the shares back that you're borrowing, you took that loan out, you have to pay it back. Got to pay the piper. Well, you're going to be paying back for this much money. Now, are you profitable? No. You lost money. You're losing money. You basically you have to pay back. You lost a negative $50. Boom. You lost money onto that. Well, okay, that's fine. You lost $50. It's not the end of the world. What you can do and this is where the shorts start getting a little bit more riled up. Oh, my kid. Yeah. Oh, okay, buddy. Go ask Mama. The shorts. This is where you can get yourself in trouble. Well, you lost $50. Well, okay, I lost $50. Now, it goes up to, say for instance, 14. Oh no, man. You are getting yourself into 14. Yep. If I can push the button, 14 times that by 100, you are at $200 lost. Okay, not that big of a deal. Well, where you're going to see problems is, let's see, $20. It's at $20. Oh my gosh, we are not doing so well. $20. So $20, you're taking that, and you are minusing, because your loan, how much you have on the loan, $11.50. You owe $850. So you owe, that's how much you lost. You owe $850. You think it's still going to go down. So you double on that. You're like, hey, I'm doubling this. So I'm going to take more. I'm going to take 100 more shares out. So I'm going to take 100 more shares out. And I'm going to borrow on that. Well, borrowing another 100 shares. I can do that. So, and boom. You got $2,000 now. You are getting money off of that. So I'll make it a little bit simpler. So you got the 11, and then we were borrowing another one, another additional. Copy this, paste this, and we are borrowing at $20. So now we have an additional loan onto that. So our total, I'm going to put the total up on top here. So our total is, we are at 315 onto the loan right now. So this is our loan. We are seeing this loan. Well, so you're taking the money, you're taking additional, so you have 200 shares now you are borrowing on. Well, Ford's going up to $30, and you have basically averaged it down as much as possible you can get. Well, let's average this. I forgot about averaging, so let's do the average. Add that plus with this, and then we take that, divide that by 2, so you're looking at $15. We're averaging at $15.75, so we're going to average that at $15.75. So that's the average onto our shares too, and it's at $30. Well, now you're at averaging at $30. Well, you are lost half your portfolio. You still lost half. Now you're like, well, it's at 30. It's at 30. I'm borrowing more. You know what? I'm gonna borrow more. And for 30, so we're gonna do 100 more shares, and we're gonna have another loan here, and this is gonna be another 30. So we're gonna have to add those up too. So we got that, and we're gonna add another 30, and you can see, well, we're getting more money, but what's happening is we were taking more risk onto it. We're taking more of a loan, and we are taking this loan out onto the money. Well, now, because we got that average again, we got to add that average again, and we're going to divide that by 3. Okay, we're $20. Our average is $20. Now the bank is like, well, because he's taking out money here, he's taking out the average, and it's going a little bit lower. The average is, what was it, 50 cents, and so the bank is not doing any like margin calls onto it. But keep in mind, you're taking loans out onto that as well. Now, say for instance, Ford goes up to, it starts heading up to $50. It shoots up to $50. They got great news. $50. The bank is going to flip out, and they're going to come back and say, hey, guess what? You owe us, for the $50, you owe us $15,000. So that's how much you have to pay us. Well, meanwhile, your loan is at the $6,150. You owe the bank, you lost $8,850. You lost that much money. So shorting is an infinite amount of risk. You can lose a huge amount of risk onto shorting. But what happens is these big banks, these big hedge funds, they will take and they will short and short because they can get more leverage back into their pocket. So now you take this money here and you can just keep on adding to it. Let's just keep on adding that 0, 0, 0. Well, we're going to have that 0 come up, and you're looking at like $61,000. Well, you can easily take out $61,000 on the loan. You're looking at all these, this is where you can get yourself into trouble. $61,000 onto the loan. Now, because you had that 0, look at this. Let's times that by 100. That should be, I should add it to 0 maybe. But yeah, you're looking at a huge amount of loss on there. Oh, I should probably just do this. And 3,000 shares. Well, right there, minus that by 61, you're looking at $88,000 in loss. So what we're seeing into the market, and this is where the market can be really crazy. The market, these hedge funds are taking this, and they are taking this money, and they're using it, and they're reinvesting it into other things. So they will short one thing, like Ford, for instance. They will short Ford, and then they will reinvest it into another company. So this is going to be a very tricky, and this is where it gets into a very bad situation, is when you have Ford having this much of a problem going up, and all suddenly these hedge funds don't have the capital. Where are they going to get this money? They're going to liquidate from other areas of the market, and you can see the market dropping. This is the problem I think that we're facing. You can see the market will have all these other liquidations because this is not money that they earned. This is money that they basically have leveraged out over time. And why I say that is we go back into the GameStop scenario. We go back into all these other scenarios, and you can see right around this time it just starts dropping. Well, this is not the GameStop scenario, sorry. The GameStop scenario was around, I think it was around this time, and you can see a little bit of dip right in here. So it did a little bit of dip. It was not that big of a deal, but now we have everything dropping at the same time. Everything's leveraging it out. It's like it's moving money away. Everything's moving out the money. Well, the money is going to get shorter and shorter onto them. What we have to realize onto this is interest. They have to pay interest on top of this. Well, this is where you see the little companies coming into play. Little companies, they won't short Ford. They will short like tiny companies that have they're not that well known. They have no dividends, because when you short a dividend stock, you have to pay dividends on top of the borrowing shares. So a lot of these companies don't want to short dividend stocks. They're a lot more protected. They're a lot more stabilized, and so they don't go after them. They will go after the young, new companies that have no dividends. They have nothing out there as well. And why they will do that is because when you short it to the wazoo, like you short it down, like Toys R Us, they were shorted very hard. Sears was another one. They were shorted very hard. When you short those companies down into bankruptcy and keep on shorting it to the bankruptcy, well, you borrowed these shares, correct? How can you buy them back? So how can you buy these shares back when the stock is closed? The shares are no longer there. You can't buy them back. So what happens is you keep that $61,000. So you keep that $61,000, you basically won the game. And the top of it, because you can't close the position because you borrowed on the shares, it's tax-free. You can't close on the deal. These are going to be on loan for infinite amount of time. That's what they're showing. But they would just close the position because they can't close they can't buy those shares back. You borrowing shares.
Like that.
Oh, okay. That's my. Um, so with this is a. It is interesting because you can short onto the market, and you can short anything when you figure out that you can borrow onto stuff. So you can short US dollar, you can short the US economy, you can short the Bitcoin. Right now I'm into shorting Bitcoin. There's infinite amount of things where you can short at, but what you have to realize is the shorting is a very, very risky thing as well. You have a high risk, but you can get a high return. So you can hear my kids over here. I'm gonna let you guys go. I'm hoping this has an educational. Okay, bye.